Trading futures and options on futures involves substantial risk of loss and is not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility. And although this could be an equation for opportunity, it's also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition of risk capital is money I could afford to lose, doesn't change my lifestyle, or overly stress me out. As human beings, we make bad decisions when we're under stress, so be in a good spot. Remember, micro contracts could be friends. Take it easy on the day trade margins. You get plenty of leverage without maxing out on those day trade margins on a regular basis. We'll be taking a look at a real-time simulated live NinjaTrader trading platform today, and none of this should be construed as trade or investment advice. Past performance not indicative of future results.
Well, good morning and good afternoon. Welcome to Develop Your Edge with Anthony Crudele. I'm your co-host, Tom Schneider, CMT with NinjaTrader. And let's get right to it. Exciting topic today. Want to welcome, as usual, every Thursday, 10:30, Anthony Crudele. How you doing, Anthony?
I'm doing great, Tom. Busy day. Glad to be with everybody. Got a lot of good stuff to talk about, so I'm excited for today's show.
Yeah, this is great. Yeah, an interesting day today for sure. Busy. For dog days of summer, you wouldn't think it's that busy, right? But not the case. And certainly with what happened last night and this morning, futures advantage goes to futures because we could participate in the after hours market. But excited to hear what you have to say. And I'm looking at your chart early before everybody else. It looks really good stuff.
Yeah, so today's topic is, if I was 18 in 2023, man, I wish I was, because I started in this business when I was 18, 19 years old in the mid-90s. And what would I do in today's world? And so I'm actually going to start at the charts today because I put a tweet out this morning, talked about how I was looking for 44, 47.5 to test. And I like to put out my commentary and talk about why I thought that area was going to be important to test. And the reason why I actually want to start there is because it is going to kind of tie into what I would do if I was 18 again in 2023. So let's just go to the charts. Let's start off with some market commentary this morning. And so here we are on my 60-minute chart, Bollinger Bands, 20 period, 3 standard deviation, my fib. You guys know that I use a 30, 50, and 70%. I've talked about this a lot. If you haven't heard about that, you can see that in previous shows, but that's what I look at on the outsides of the Bollinger Bands. So if you're new to Develop Your Edge, that's something that I look at. You just hit the F8 key on the NinjaTrader platform and you could draw your fib. And then I look at my boxes, my area. We actually did a whole show specifically on this. And today is the perfect example of what I look for a mean reversion trade. So the big primary trend we know has been bullish. As of late, it's been a little bit bearish. Okay, so there's going to be, what is the primary trend? What's a mean reversion trade? Well, the bottom line is the overall trend on the big picture is still bullish. And so what I look for when I'm looking for a mean reversion trade, the confirmation I want to find is when you get a strong move up, like we saw. We had NVIDIA earnings, which is an interesting thing as to why futures, I think, or if you're going to be trading the S&P or NASDAQ or Russell or Dow, it's obviously, I think these are the best tools because you're going to get a lot of information during a time where you're going to get a lot of volume after hours. And you're not going to get that from the SPY or the QQQ. You're going to get that information. People are going to be going to the futures markets. And so when you see a move like that, it actually sets up for the next day of trading. So really all of today's move lower is really set up because of the move higher yesterday. And what do I mean by that? Well, what happens is that the market ends up getting to the point where it just can't go any higher. So you get news and volume that drives the market to a certain price. 44.80 was that area that came up on my Bollinger Bands. And I'll show exactly why in just a moment. And then you have that market push back. And, the buying, what's interesting about today's markets is that there's a lot more one-dimensional than they were in the past. And what I mean by that is the markets will push in one direction until they get to a point, and then they'll just push really hard back. And that's just what you see a lot more versus, I would say, 20 plus years ago. The markets were a lot more grindy type markets, a lot more range-bound type markets that slowly inch their way to prices. Except for maybe the 2000 bubble where that just kind of, was crazy time. But majority of the mid 90s when I first started, it was just a grind, typically higher, but the market just didn't move the way it does now. It just didn't zip up and then zip down. Part of it is because pricing today is a lot more expensive. The S&P is at 4,400. When I first started in the S&P pit, I want to say the S&P was around 600. And so it's 3,800 more in pricing. And so therefore you're going to get a lot more volatility in price, maybe not percentage wise. And so getting back to why I think today is a perfect example of what I'm looking at is when you look at what happened on these Bollinger Bands, and this is like I've talked about these quadrants. You get up there, you cannot get in the 30 percentile of the peak of the Bollinger Band, and the market just had continually hourly closes below it. We open up this morning, and then this is what I call a move underway. 44, 47.5 was underway. This morning I put a tweet out and I said, I'm looking for that to test this morning. And the reason why, even though I'm still bullish, okay, we'll see how it goes the rest of today, the market it's got a move that's underway, because when a market can't hit a price or get above a price that I think is important, like 44.80, because of what I looked at here in my fib tool with the Bollinger Bands, the market pushes back to that next area to test it. And it usually does it quickly. And so that NVIDIA move set us up to pull back to this 50% area. And I talked about this in the tweet. I did. If you go back and look at my thread in the tweet, in the X, and there's so many words for all these different social media platforms now, I said, I want to see an hourly close. The reason why I want to see an hourly close is anytime I'm testing a level on an hourly chart, I want to see the hourly close, because it will tell me if it held it or if it didn't hold it. Is it support or is it resistance? Because my 50% line is what I call the pivot. Especially when you look at a pivot, you never want to be first in buying on a pivot. You never want to be first in selling on a pivot. You want to watch the hourly. And this is another perfect example of a day like today where I look at it and go, if it can't hold 44, 47.5, 44.15 is possible. Hourly closes below it, brings in the lower price point. Hourly closes back above it, bring in the higher price point. And so that allows me to be patient when looking at a pivotal area. A lot of you guys have a pivotal area where you look at and you go, it's kind of my neutral. I like it. And a lot of times you might find yourself trading that area right when it gets there. And to me, that's a huge mistake. Anytime I have a pivotal area, I set another, something, whether it's an hourly close or a confirmation for this, it's specifically an hourly close, to see how it trades and holds that area, because I'd rather be last in at a pivot than first in. And so hopefully that made sense and just gave some commentary on today before we get into laying that groundwork if I was 18 again.
So, Anthony, real quick, I noticed your Bollinger Bands, of course, we've talked about them before. I like the way you sectioned it off into quadrants. You can't get above the 30% area, right? That's resistance. And now you're targeting the 50, that's your pivot. And now that we've broken down, you say the 70% level is possible. The Bollinger Band, though, is the Bollinger Band telling us that we're in a trend, or are you looking at the Bollinger Band as well as another area of support? To me, I think the Bollinger Band is more informative as far as trend rather than a support or resistance level, but curious what you think.
I literally only look at the Bollinger Band as boxing it off. And so when I look at it, I am only looking at it with the interest of the peaks.
Got it.
Once this happens, like this mouth is opening right now versus closing earlier, doesn't really indicate much to me, except the fact that if we did get an hourly close down here and the Bollinger Bands are opening, you can expand in that direction. So that just brings the likelihood of 44.15 in play. If that Bollinger Band was still pointing up and we were to close back up above 44, 47.5, then I would say we're still boxed in. We're still probably going to spend more time in this box versus this box down here. And so it does help with the confirmation of the hourly close, but the hourly close is still going to be more important to me. And I'm still only looking at where they are boxed off from peak to peak.
Interesting. Okay, great. Thanks for that.
So let's lay the groundwork. Today's focus is what would I do if I was 18 in 2023? And so how do we walk back to that moment, right? And so it's one of those things where if I were to say to an 18-year-old trader, what's the first thing that I would do? I mean, the first thing I would do is, because of the micros, the introduction of the micros, I would start, and obviously we're going to be talking about starting in futures. I still think if you're going to be a day trader, if that's your goal, I think the futures market is a much better choice for you. Tax advantages, cost efficiencies. There's so many different reasons why I believe futures are a better place for day traders. And so I would start with opening up an account, getting myself situated, and I would spend some time looking at the different markets, and I would try to build a relationship with those markets. And what do I mean by that? How does a market move in news? How does a market move at the times that I'll be trading? What are the different nuances that market has? You go to a corn market, or you go to a 10-year market, or you go to a 30-year bond, or you go to the NASDAQ or the S&P. They're not just charts on a screen. They all have different personalities. And there's different people that find that certain markets fit them much better, because we're all really different, right? I would go back even like last year, I was trading NASDAQ more than S&P. I'm trading S&P now more than NASDAQ. It's kind of like just dependent on where I'm at, what I'm seeing technically. And so before I got to that point, being able to go from one market to the next, I had to watch a market for a period of time and see how it moved during the times I was trading, the news, and all those things I talked about. So that's the first thing. The second thing is, I would start with a simulator, but I would be on a simulator for a short period of time. And it would be all about just getting the fundamental basics of execution, right? What's it like to buy? What's it like to sell? How do I work a stop? Do I work a bracket order? How do I trail a stop? Something's happening quickly. Get used to that, that movement. If something happened really fast right now, I'd be able to go bink, 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 and I'd be able to click in and out really fast. And so you need to build that skill set there before you go live. And during that time, it goes without saying, you also want to be building a strategy. Now, everyone would say, well, what kind of strategy? And I'm going to say, super, super basic. And the reason why I started today with the Bollinger Bands and that look, this is actually the first strategy I ever developed for myself. This strategy is over 20 something years old. And it was because I took a weakness of mine at looking at the market and I made it into a strength. And what was the weakness? The weakness was fading trends too early and then getting back in at like pivotal points or areas of support resistance too quickly. So I'm the guy who's selling it too early, and then I'm the guy who's buying the break too quick. And so I just got to be in, right? And so what I did with the Bollinger Bands was I created a strategy that helped build patience. Everybody talks about patience and discipline, but you need to build it in as a new trader. You need to have a very simple strategy that will take some of the weaknesses. Maybe you don't know what you have as weaknesses yet, and you're going to continue to work on that, but you build a strategy that's very simple, very basic, but it forces you in and it forces you out. So the strategy is, in many ways, I would say you want to be almost purely systematic to start, because you want to have triggers and you want to have reasons, and you want to be, going across the board. Look at this, told me to do this. This told me to wait. I have to be in now. And then you start doing that in the micros. Now, the micros are great because the micros to me are, now I know for everybody, it's going to be a little bit different, right? How much can I afford? How much should I put in a trading account? And actually, Anissa put this on Twitter, not to get ahead of Ask DYE, but it's a great question that ties into it. So I'm going to be answering it right now. How much would I put in? Obviously, everyone's going to say, put in the amount that you're comfortable with losing. And I think that most people traders that have been around would say that's the number you should be putting in. And some people would say, well, how much is that? Well, if I can afford $5,000, $50,000, $500,000, if I can afford to lose that, does that still make sense? To me, you want to put in a low number amount that allows you, dependent on, you're going to be trading micros, what gives you enough buffer that you're comfortable with losing per day, per week, per month, and give yourself I would say 3 to 6 months of buffer in the account. So where if you lose your max daily, weekly, or monthly limit, you're still in business for a period of time. And so that number is going to be really dependent. I don't think you need a ton of money to trade the micros because you could probably get it into account for $1,000 to $3,000 to trade micros. If you're just trading 1 and 2 lot, even the S&Ps or even NASDAQ or Russell, they're not very expensive. And so you got to give yourself a relative risk amount to last long enough. And so to me, there's not a right number. It's just about lasting long enough, giving yourself that gift of time to actually let it play out. Because what most people do is they'll come in, they'll put amount of money in that they're willing to risk. They'll trade that for a while. They'll probably stay pretty steady with how much they're winning and losing. Maybe they're breaking even, making a little bit. And then a lot of it will just come out really fast. They'll just lose a bunch in a row. And they just didn't let it play out, right? They didn't have the patience. They didn't have the vision of looking longer term. They get frustrated. And then once you get frustrated, you kind of blow the account. We've all been there. We've all done that. If you haven't, I don't know. Lucky you. But I've done that several times. I was the best risk manager in the world until a certain point, and then all of a sudden I'd have a bad day and I'd want to fight it back, and I would trade a ton and I would lose more. And so to me, that number is about giving yourself that thought process 3-6 months out. I'm going to let this play out, do an evaluation after that point in time, and you can see where you're really at. And so to me, that's like the fundamental basics of where I'd start. And then when it gets to the strategy side of it, the technical side of it, don't have redundant indicators. I remember a time where I had MACD, RSI, stochastic, all these different things. Obviously, Bollinger Bands really have always had those on. And I had a lot of indicators that were giving me similar indications. Stochastics, RSI, MACD, you're going to get a similar indication. And what happens is your mind's too busy. You need to have an indicator that does something for momentum. You want to have a fib tool, or you want to have, I believe, obviously, you guys know how I feel about a VWAP, order flow, and all of that. Don't be redundant with your indicators. That's one of the biggest mistakes that you'll make, because when you go in there, it will cause hesitation. And when you have hesitation, that's when most mistakes will come, because you're either going to be somebody who steps in and overtrades, or somebody who's a hesitant person and doesn't take the trade. And then next thing you know, you've created a bad habit that you didn't come back to, that you keep coming back to. So I think Anthony, mentally, that's the basics.
With your comment about having redundant indicators, I don't know how many times I would see a trader's screen with, like you mentioned, RSI, MACD, stochastics, commodity channel index, DMI, because they could, right? Because it's available. And, my question to them was, okay, which one are you following, right? Because exactly. they give similar indications, but when you're talking about triggers, well, one might give a trigger a day before, 2 days before the other. So which one are you prioritizing? And when you put it to somebody who's new, okay, what are you looking at? What are you really looking at? And what are you focusing on? If they can't answer, you got to start again. And I think you said that, right? It's too confusing it's distracting to see 5 different indicators doing basically the same thing through different calculations. Completely agree. Keep it simple is where to go when you're starting out.
Yeah. And let's go back to the charts, and let's dive into my strategy, and the strategy that I would talk about for myself at this point in time, because it's a strategy that I use. And I wish I had this mindset when I first started. So first thing is, when you're building your initial strategy, you have to have perspective. You've got to look further out. I've said this in a ton of my podcasts. When I get asked this question a lot, what would you give advice to the new traders? And it's always think long-term, and your short-term results will be there. Because when you first start to trade, the only thing you think about, at least the way I thought about it, I need to make money today. I need to make money right now. What am I going to do when I make money? All these different things. You're not thinking defense. You're not thinking long-term. And it's funny, I'm in my mid 40s now, and I think more about my life 20, 30, 40 years down the road than I did in my 20s preparing for my 40s and forward. And obviously that all comes with age. But when you're a new trader, young or old, your mindset is still today because the action's right there. And so you need to step back and you need to look at a longer term time frame, even if you are a day trader. That's why we start with the daily chart. That's why we start, I think, with a simple momentum indicator. I like RSI, overbought, oversold. I like to start with the simple order flow tool, cumulative delta. I like to start with a simple moving average, and I like to look at Bollinger Bands. It gives me different levels, right? Not levels of trading, but just different levels of what's happening in the market. It gives me context in different ways. Bollinger Bands give me the breakdown of, are we expanding in volatility? Are we contracting in volatility? Moving average, where are we relative to the prior day's price action? Are we grinding higher? Are we grinding lower? And a moving average will just tell us, and I have a 5-day up here right now, is the average price higher or lower, right? That's it. It's simple. Okay, prices right now, you look at Bollinger Bands, and right now the Bollinger Bands on the bottom is opening a little bit. The top's kind of flat. We're essentially very wide between the top and the bottom Bollinger Band. And so in the bottom Bollinger Band's pointing down. So we're not really contracting. We're still kind of expanding in volatility. And so when you know that, look at a day like today, I come in and expect a lot. So my mindset is, okay, we're above the 5-day. It's a little bullish. We've been bullish all year. We've had a good NVIDIA numbers. Let's see what the 60-minute says, because I think we're going to get some volatility. Also look at the cumulative delta. Huge up-day volume yesterday. And anytime, I've talked about this a lot as well. When you look at cumulative delta, what this gives me this perspective of, a lot of people will say, I want to see a rally with high volume in a stock. Like if I see that in Apple, it's a little different than seeing it in the S&P 500. If I see a big up-day in volume in the S&P, I like to look to see what did it do in terms of price, and what did it do in terms of my next level of charting, which would be the 60-minute. And I'm going to look at really on here, just Bollinger Bands, all you really need. At least that's what I like. And it just gives me those boxes that I talk about. Did the volume that came in yesterday that was very strong with that cumulative delta push above my highest resistance level? The answer is no. And so a lot of times what happens, and just think about this when you're doing your strategy, you're like, okay, I saw a big up day, volatility still expanding. I go to my next time frame. What's it telling me? Market couldn't get above this area. Okay, be careful. It's still bullish, but you could see some unwinding of that really strong volume push and start to rotate lower. So you go from bigger picture perspective, slows you down. You take yourself to a middle time frame. At the middle time frame, you're looking for more confirmation. You're trying to hone in a little bit more, and you're trying to get some of your levels to trade off of. And then, of course, you go into your 3-minute. And I talk about this all the time. So you're going to take my horizontal lines, and I'm going to move these up to the opening 3-minute range. And I'm going to watch an anchored VWAP, and I'm going to have these standard deviations around the anchored VWAP. And this then now allows me to hone in on what's happening right now. And so you go from longer, medium to short term, and that's what will help you with your execution. This is one of the most important things I would do as a new trader, because when I first started, I would either look at the daily chart, be bullish or bearish, come in and try to trade that way, and then I'd get blasted. Or I'd make money and then I'd get blasted because it was too wide of a stop, and I'd be right and I would lose money. Then I would go to a medium time frame and I couldn't manage my risk as well there either, similar situations. Then I go to the short term and I would just overtrade way too much. And then I'd be like, well, I need to go back to the other time frame. And you're just like, what am I doing? And the problem is I wasn't taking each one of them and putting them in the different perspectives that they are. I just minimized my indicators and said, look it, do you want to be bullish or do you want to be bearish? Where is majority of the confirmation?
Well, what's interesting about yesterday, I think when you have an event like NVIDIA earnings, that strong move could be false, not false, but it could be misleading to a new trader, because everybody's bullish, right, at the earnings. And what you're doing is you're saying, okay, let's put that move in context and let's break it down as it unfolds during the day. Meaning, let's go to the 60-minute, let's go to the 3-minute, and realize that, well, all those participants yesterday might be unparticipating today, right? They might be taking profits. They might be, it's a different day today than it was yesterday, even if yesterday was 4:30 and we only go to 5 o'clock, right? So I really like your style of going from top down rather than bottom up and just jumping in.
Yeah, and I would say that a lot of veteran traders, most all of them are going to do something similar, right? And that's why the point of it is, if you're a newer trader right now and you're, just getting involved in the business, the thing is you really need to put these things into place, because it talks about, what the reason why you have to put them into place is because you can't just come into this business and think, I'm going to have patience, I'm going to have discipline. You're going to talk about all these trading psychology points, which are important, but they don't really mean anything to you yet because you don't have a proper routine and preparation in place. And so psychology of these patience and discipline, important elements, come into play only after you've built the proper structure. And without that, you're never going to be patient. You're never going to be disciplined. You're never going to really know who you are as a trader, because you've never given yourself the time to let it play out. That's the biggest mistake I made, was I never let it play out. I'm always searching for today. I got to make the bills today. I have to pay my bills at the end of this month. So it goes back to, like, how much money should I have in an account? You need to have enough to let it play out a period of time. It doesn't matter how much you can afford, because if you start off with $1 million in your account or 1,000, you're just going to lose $1 million or you're going to lose 1,000. I mean, I hate to be the bearer of bad news. I'm not saying that to be very negative about it, but the reality is it's not about how much you can afford to lose. It's about what is your strategy? What is going to be your average risk per trade, per day? What's your risk per week, per month? And give yourself that amount of time to where if you're just dead wrong for 3 to 6 months, that you're still in business and you're still executing based on the plan of that projection. Because you're not just putting money in what I can afford to lose, because at some point you lose that money today. And that's the mindset I kept having. Put more money in, I got to make it right now. And when you can't, you implode. And that's just a mistake that people make.
Anthony, one thing that we haven't talked about, and I know we're running up against time, and want to get to the Ask DYE because you've already answered it. But I think something that's unsaid, but it might have been implied, is after all the analysis, you may come away with, this isn't your day to trade, right? You might not see a setup. You might not see that today is a good trading day. So when you talk about an 18-year-old, 19-year-old, 20-year-old saying, I've got to do this today, and I've got to, let's say, try to make this amount today. But there are some days that you just won't be able to find a good trade. Is that accurate? Or?
Well, yeah, it goes back to, that's installing patience and discipline, is that if you put things in play to force you in, you're going to be patient or disciplined. Most beginner traders, really, I should say, all beginner traders should start off very systematic, if not only systematic. Discretion should not be in your trading at this point, because discretion is only going to bring bad habits, because you don't know what you're doing.
Right.
And if you can admit that and understand that, then you could come in with a clear mind and you could accept the loss. You know how to go in and lose. You know how to go in and win, because you've put things in a systematic structure. Over time, you can create some discretion. And that's where it's like comes in for me. You've been doing this for a while. As you get better, you go back and look, what did I do here? What to make myself a little better? You look at that and go, you know what? You start, maybe I'm only going to inch in. If I'm going to do 10, I'm going to start with 3 here, because this situation, I keep getting stopped out with a full 10 lot on. Why? Oh, you know what? Look at what happened in the NASDAQ today. The NASDAQ wasn't showing me this. Oh, look what was happening in the bond market, or look at the dollar today. Then you start seeing things away from your strategy that you bring in where discretion becomes valid. That's the difference. You just can't do that early on.
Right. Okay, great. I I didn't frame it in that concept, but when you put it into the systematic aspect that you start out with, makes perfect sense. So appreciate that answer. I just want to let everybody know the Ask DYE question. Go to Twitter, put in a hashtag Ask DYE, and send it out there. Just post it. Make sure you put at NinjaTrader. You can ask Anthony anything, and if we use your tweet, we'll give you a nice little reward. This week, Anissa contributed a question about if you were a beginner trader, what sum would you invest in your account? How many instruments would you trade? I think Anthony did a great job of answering that. And thank you, Anissa, for being a regular viewer and a contributor to the show. But we have a little bit of business to do, right, Anthony?
Yeah, last thing is, I keep mentioning this, but it's so important, is the Battle of the Bonds Interest Rate Trading Challenge, September 10th to the 15th. You'll see the link down below in the YouTube description. It'll also be on my website for this link. You can just Google it for CME Group. I just think that this is such a great way, and I know I've been talking about this a lot every week in the show, to understand how interest rates move. We are at a time where interest rates are so important, not just to us as traders, but just as people in the world, in the United States, the way interest rates are moving. Everyone talks about mortgage rates, all these different things. So much of that is set off of the 10-year. You can come in here and you can actually trade these markets, see how they move, and you have a chance to win $2,500 for first place, $1,500 for second, $850 for third. And I just think that, I wish they had these when I was starting, because it gave me an opportunity to win some money while I'm trading on a sim. And who knows, I learned from this market that maybe this is a market I want to trade. Maybe I do very well. Maybe my strategy does very well, and you take it seriously because there's actually money attached to it. So I just think it's something cool to do.
Yeah, I agree. I think it's been a great series that they've been doing, and I hope they continue that. With other products going through the rest of the year, maybe into next year. That'd be great.
Yeah, I think that they are going to continue with that as well.
Awesome. Good. Well, thank you, Anthony. Of course, always a pleasure to have you on your own show, right? Develop your edge, but great to hear what you have to say. Thanks for your time. Of course, how can people find you?
Anthony Crudele on Twitter. There's only one. I know there may be a bunch of other ones out there, and I don't send DMs, and I don't have a private Twitter, and I don't have all these other things. That's the one you see. That's it. And of course, anthonycrudele.com. And I also mentioned placeyourtrades.com. A lot of cool stuff going on there. Huge month for Place Your Trades coming up in September. Can't wait to share that with you guys. So that's going to be cool. Go there and check it out.
Yeah, looking forward to that, Anthony. Thanks so much. And thanks to you viewers for showing up. We'll finish the day today with Mike Burke at Bars Closing. In the meantime, have a great trading day.
See ya.